Here's a problem I didn't expect. I built three trading strategies. One for bull markets, one for bear markets, and one for sideways chop. Each one works in its own condition, but markets don't tell you what condition you're in. So this week I tried to fix that. I built a bot that reads the market and automatically switches between the three strategies. Now I know how that sounds. AI picks your trades for you. It sounds like a gimmick or something that's gonna overfit and blow up when conditions change. But it's not doing anything magic, and it's not even picking the trades to take. It's just reading volatility and direction and deploying whatever strategy I already tested performs best in that condition. And when I ran it against the prop firm's actual rules across 3 years of data, it actually beat every individual strategy. I'm not a trader with some repeatable system that prints money. I'm just testing this stuff and showing what's happening. Here's what I found. So last week we built three strategies, one for a bullish market, one for a bearish market, and then one for a sideways market. The bullish one was momentum based, the bearish one was mean reversion, and then the sideways one was a volatility squeeze strategy. Then the plan was, depending on what the market condition was, either bullish, bearish, or neutral, we would deploy either strategy number 1, 2, or 3. So we built out the most bare bones versions of those three different strategies. Now we're refining those strategies and upgrading them, where each upgrade has an evidence-based reason behind it. Last week we did this with the momentum strategy. This week we're going to do it with the rest. You can watch the video from last week to see exactly what we did, but here's a quick overview anyway. It essentially broke into 3 parts: filtering out bad trades, adding a trailing stop to let our winners run, and then aligning it with prop firm conditions. Now we're up to this current week. The first one that I worked on upgrading was the mean reversion strategy. The old version, like I mentioned, very bare bones, very simple. However, it was a little too simple and it was taking a lot of bad trades. It was based on the simple moving average of price. Here we can see what that actually looked like on the chart. Price came above simple moving average, entered a short, and then here it worked out and shorted down to this point and then exit. It was that simple, but 2 issues can occur. One, when it's flipping back and forth really quick around the simple moving average, and then 2, when price breaks out. So, as you maybe could have guessed, the performance of the strategy was not very good at all. Over a year, where the return on a buy and hold would have been about 20%, this strategy returned negative 1%. And this, by the way, is before commissions and slippage. The one good thing about it is at least it's not very volatile. So, how do we improve it? Most importantly is adding a buffer using ATR. So ATR is used a lot of times as a measure for volatility. We're using ATR here to help determine how big the buffer is, and we're using the buffer to help filter out those trades that are taken when price is just flip-flopping the simple moving average. So here's the buffer. We have the simple moving average here, upper bound, lower bound, and then you can see it varies with volatility. And again, we're using ATR as our measure for volatility. Here we can see pretty volatile part of the market. The distance between the upper band and lower band is more extreme as compared to, in this range, less volatile. The distances between the bands are much closer. So what does this do? Well, it does what I actually intended the mean reversion strategy to do originally. If price gets a certain threshold from the mean, that threshold being contingent upon the volatility of the market at that time, then the strategy will take a trade back towards the simple moving average. So here we see price comes down and hits that lower threshold distance away from the simple moving average. So it takes a long position back towards the simple moving average. I think I do need to work on finding the optimal target for take profit and stop loss, since this is a mean reversion strategy and I'm not going to be using a trailing stop. It just wouldn't make as much sense. The whole thing we're betting on here is that price isn't going to break out, that it's going to revert. It's just with fixed exit points, it's going to be really hard to know whether what you're changing is actually better for future market conditions or if you were just overfitting to the data you were testing on. All right, so that was the second strategy, the mean reversion. Now, moving on to the third, volatility squeeze. The thing that made the biggest improvement here was adding a trailing stop. Why do I think that is? Because this squeeze strategy is a different form of a breakout strategy. It measures volatility in two different ways. First, with Bollinger Bands. These measure volatility based on standard deviation. The second measure of volatility in this strategy is Keltner channels. I'm not sure if I'm pronouncing that right, but these measure volatility with ATR. So it's two different ways to measure the same thing, and then it compares them and takes a trade off that. So what do I mean by that? Well, say you have price here. We're going to divide this price action up into 3 segments. 1, 2, 3. It's a 3-stage process with this volatility squeeze strat. So the Keltner channels and the Bollinger Bands both have upper and lower bounds. Given that they're based on different things, they have slightly different tendencies. The Keltner channels tend to be inside of the Bollinger Bands. The Bollinger Bands tend to be a little bit more fickle. Now, given that the Bollinger Bands are more fickle, sometimes they might move inside of the Keltner channels. This indicates that volatility is very squeezed, very compressed. So, when the Bollinger Bands move back outside of the Keltner channels, that gives us a signal that the squeeze has released, the volatility is expanding, and price is about to explode. And so we take a trade off of that, and that's why I was saying it's kind of like the momentum breakout strategy. And so given that this is sort of a breakout strategy, when we added a trailing stop to this, the results improved by magnitudes. Here we can see an absolutely beautiful equity curve. Super smooth and very little drawdown. Now, given the initial starting capital, this return is not out of this world. It's a 2% return. The market returned, again, about 20% over this period. That's a tenth. Why would this be good? Because it's for prop firms. You can always scale up the capital or trade on a margin and have this numerical value go up given the same percent returns. The reason that's risky is because of drawdowns. That's why prop firms have such strict drawdown limits. And that's why this equity curve is so beautiful. It has such little drawdowns. So now let's compare the 3 different upgraded and refined strategies. Here we can see the 3 equity curves of the 3 different strategies over the same year. And here we can start to see the advantage of using different strategies based on the different conditions. For example, we may wanted to have written off this mean reversion strategy very quickly, as looking to trade prop firms, the drawdown is just too much for how little profit there is. For example, this momentum one has some decent amount of drawdown too, but the profit is way higher, it's more justifiable. So why would you ever use a mean reversion strategy? It's clearly not as good, but it's contingent upon the conditions. Here we can see the squeeze strategy and the momentum strategy about broke even or lost money during these market conditions, whereas the mean reversion strategy, that was the only time where it actually created profit. Another example, during this period from September to December, the momentum strategy lost money, the mean reversion strategy lost money, the squeeze strategy gained money. So again, hindsight bias, but if you could find a way to at least some way guess, all right, squeeze strategy here, momentum strategy here, mean reversion strategy here, eliminating a lot of drawdowns, taking the best of the profit. You're not going to be able to do this perfectly, of knowing perfectly when to switch strategies. That's not necessarily the goal. It's getting an estimate. It's saying, okay, at some point in this range, let's switch to momentum. At some point in this range, let's then switch to mean reversion. Here, I went into a little bit more detail about which strategies are working best in what conditions. What I'm really trying to do here is pull out those characteristics of the market where a given strategy is performing well, because if I can pull out those characteristics, I can then use those to create the regime indicator for when to deploy what strategies. Starting with the squeeze, we can see it's the only one that's profitable in this weird market condition where price is jagged. It's what I started labeling as high time frame volatility. Then next one, we're looking at the momentum strategy. This performed again in high time frame volatility because it's a breakout strategy. But here, directional breakouts. as we can see here, price would break down and then break down again, break down and then break down again, break down again. And it was following a direction with the breakouts. That's where the momentum strategy worked very well, accrued a lot of profits from here to here. Then lastly, the mean reversion strategy. So the characteristics that I was pulling out here is high, low time frame volatility. So the volatility in terms of ATR in the range may not be so high if we're looking here. That's not a huge range. If we go back to here, these jumps are much bigger. There's a lot of more frequent, smaller chop. And that's where the mean reversion strategy seems to work better. After analyzing that, I tried to pull out those characteristics of which strategies work best in which different market conditions, and then what characteristics are those market conditions defined by, and using that to create the thing that's going to tell us which strategy to deploy when. Now this is a little bit of AI slop because I basically just told an LLM everything I just went over, all the characteristics, what I wanted from it, and then I gave it the 3 different strategies that we had upgraded and said just create this switch based on these characteristics that I'm noticing, and then deploy one of the strategies I'm giving you depending on what characteristics are present, and then incorporate a grace period so that it's not flipping from one strategy to the other constantly if market conditions are finicky. This became a very long and convoluted piece of code because it also includes each of the 3 different strategies. And I think that's a little unnecessary. I think I could create something simpler, and I want to. Then the last thing to do this week was to test over multiple years. So first, the master strategy. This is where we had the regime switch that indicated which strategy to use, and then we deployed that given strategy to the market. So 2025-26 was the year I was looking at originally, and the returns were 15,000. The year prior to that, though, would have been excellent with 50,000 in terms of returns. And then prior to that, around $6,000 in return. This is much more variance than I was expecting, and I'm definitely glad I have access to a lot of data to be able to do a lot of testing. I didn't have super high hopes for this, as again, was a little bit rushed, and I need to spend some time refining that. But the initial results are not bad. Next, let's take a look at the upgraded momentum strategy. Now this was surprisingly the worst because the main year I was looking at was the 2025-2026 year where the returns were 53,000. So then when I went back one year and they were negative, I was like, oh, wow. This is not super unexpected as the momentum strategy has been the most volatile so far. Definitely not a pretty sight to see. 2023 and 2024, not much better. Yes, there was returns, but again, we're not optimizing for returns. We're optimizing for small drawdowns. If we wanted returns, we'd buy and hold and get 24% returns. We're optimizing for small drawdowns. All right, next up, we have mean reversion. Now, this was more unsurprising. It was very consistent. 13,000, 15,000, 12,000. Pretty similar profit factor each year as well. However, max drawdown on this 2025-2026 year is just way too high, and the consistency is definitely promising and something I want to look more into. So lastly, the volatility strategy. What are we looking at here? We're looking 25-26 was the best year. Very high profit factor, up 20,000 with a max drawdown of 2,300. I mean, that's incredible. If you were to run this on a prop firm, you would have to trade on margin, which I don't think is possible. But if it is, and you could, I mean, it'd be wonderful. Just a very smooth curve up. However, that was not consistent across the years. 24-25, half the profit and twice the drawdown. Then we go back to 23-24, a quarter of that profit and 3 times the original drawdown. So something promising to see, even with the master strategy and the regime switch not being dialed in at all, it still did have the highest average returns and the second highest profit factor. It is reinforcing that idea that using different strategies depending on the market conditions is the way to go. I just need to dial it in. And it's a little bit of a balance of it's incorporating that momentum breakout strategy aggression. It's then showing a little bit of that high max drawdown. I'd say the biggest surprise for me here is mean reversion. All of those other strategies at least had 1 year that was an outlier. Mean reversion, I'm gonna give you this much returns every year, in and out. So I'd say my big takeaway here is lock in on refining the regime switch, market condition switch, in the master strategy of which to use when. So with that being said, what are we going to focus on next week? First, figure out the quirks of the regime switch and what's going to be best for assigning different markets to different characteristics and different strategies given those markets. Then start splitting up the master strategy into a master strategy that's more focused on super small drawdowns for the eval phase, and then one that's a little bit more focused on profit for the funded phase. Then I want to see what that would look like over real data. Lastly, got a note, as always, do not take anything I'm saying as advice. I'm in no way an expert. I'm just documenting what I'm learning because it's cool and fun to talk about.